Stockwatch is brought to you by Merchant Waste. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant Waste. Finance, invest, insure.
You're watching Stockwatch. I'm Zinati Kuma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Drikus from Capicraft. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Thank you so much for your time, gents. I must say I'm really impressed by what the Rand is doing and, of course, what it has been doing over the last few months. JP, starting off with you. Is it just if you're exposed to the Rand, is this a good and safe space to be in right now?
Good evening, Zinate. It seems safe, or even if it isn't, you're paying one of the highest real rates in the world just to stick your excess currency in rands. So it's one of the knock-on effects of the very high real rates, because we have very high interest rates while having relatively low inflation, is if you were an investor somewhere in the world, let's say Japan, you can decide you can keep your cash in Japanese yen and get zero, or you can transfer it into South African government bonds or some other Rand asset and get 9%. Why wouldn't you do that? So, yes, we like it because a strong Rand also keeps our inflation low. But too much of a good thing is also questionable. Maybe our real rates don't need to be quite as high. Maybe we can cut our interest rates and we can still get away with foreign flows coming into our country, buying our assets, and in that way still keep inflation low, but also decrease real rates, decrease interest rates. That will really help the economy. So, I don't know, maybe the governor is watching. Governor, if you are, please, many of us feel this way. Let's see what happens.
All right, I hear you on that. Hopefully the governor is watching, JP. Drikus, just when the Rand is this strong, I mean, as an investor, what do you do? Are there things that you should be doing?
Well, let me just try and correct you. I think the Rand isn't strong per se. I think it's a weak dollar the last 9 months or so. So let's say 80-90% of the movement that we've seen is purely dollar-based. It's so all EM currencies, or even the euro and even the Japanese yen, stronger over the last 9 months. It's purely a dollar story. I think, the governor is purely, I think he's overzealous. We know why. He wants to bring inflation expectations down to 3%. Inflation expectations at the moment just about 4%. So he's getting there. Once we do get there, the cost of capital for the whole economy drops. So longer term, structurally, it makes sense. And I think the bigger problem is not the South African Reserve Bank, which is an anomaly to what we see in elsewhere in government. The problem is the rest of the environment that the government, or in some cases the absolute absence of government, has created or failed to create. So I think that's the problem. If we fix that, a lot of flows will flow in, not only portfolio inflows to our bond market, but also foreign direct investments. That's what we need. South Africa's fixed investment formation is about 15% at the moment, 15% of GDP. We need that up to about 30%. That's where China, Indonesia, India, and the likes are. That's where we need to be if we want to grow our way out of poverty. That's my 5 cents around macroeconomic policy for SA. But what do? I think we take out some funds here and there when the Rand spikes or the dollar weakens. It opens up a window to buy some offshore assets if you haven't done so already. I think the current levels aren't bad. But except for the high levels of interest rates that we're sitting at, the high real rates, we also, in terms of trade arbitrary, energy, which is our number one import, is still low, while the PGMs are shooting through the roof. So our terms of trade are getting much stronger. We're probably going to see much better current account. We might even see current account surpluses going forward, for all you know. Looking at the PGM basket, looking at the gold price, etc. And it's. I think the momentum is for the rand at the moment and not against it.
Okay, yeah, very, very interesting insights there. And as we're talking about the PGM basket, there's a question here that just came in for Valterra. The 3-year prospects for Valterra, and actually it's been doing very, very well today, up more than 8%. JP?
Well, with all these PGM miners, if you tell me what the PGM basket price is going to do the next 3 years, I can tell you if the shares are a buy or not. And that's difficult to call. So we've had a spike in the PGMs so far this year, but it's sort of like stalled in the last month or so. So you probably need the PGM prices to move further before the share prices will move up further. It's very much correlated, related, dependent. So yeah, it's a tricky one. I don't have a firm view. Generally, when it comes to commodities, I know that I can't forecast the spot commodity prices, and that's why I generally have got very low exposure to mining companies, because you first need to have a firm view about what's going to happen to the commodity price before you then can inform your view of whether you should buy the shares of the miners.
Yeah, I mean, I get that the overall landscape of PGMs is tricky. You can't really predict, but is it that tricky when it comes to Valterra Platinum, Drikus, considering that this is seen as one of the high quality PGM miners?
Yeah, no, Valterra is high quality. Unfortunately, Anglo snapped a bit of the cash off the balance sheet when it unbundled, just before it unbundled. So the balance sheet is not as strong as it used to be. But yeah, it's one of the, if not the highest quality, at least one of the majors. And I'm extremely bullish platinum, medium to longer term. I am a bit irritated that it's already run as far as it has, because I'm underexposed and I took profits too early. Because like JP, I think that it's caught a bit of a lull here. In the last 2-3 days, though, it's waken up again, and platinum on my screens at the moment is touching 1,500. But that is nothing to where it is supposed to go if you're really a platinum bull. So longer term, I'm really bullish, but the equity prices have run away from the metal prices at these levels. Valterra is kind of fairly valued. So you really need to have a strong bullish view on the platinum of the PGM basket going forward. Otherwise, they're definitely not bargains anymore.
Well, talking about bargains, I think maybe someone is seeing a bargain on ShopRite. Would ShopRite be a good time to get in now? And actually just looking at that chart, over the last week or so, yeah, ShopRite has been showing some downward movements, JP?
Yeah, the whole retail sector has been under pressure, but ShopRite came out, about 2 weeks ago with very strong results, still taking market share in the food sector, still coming out with all kinds of innovations, and across the board, whether it's the upper end with their newer Checker stores taking on Woolies, or the lower end, just everywhere they are taking market share, and the execution has been excellent. So it's been a long time since ShopRite shares were cheap. And that's why if you look at a longer term chart, ShopRite shares haven't done particularly well over the last 5 or even 10 years. They've gone up, but not as much necessarily as the all share index. They've underperformed the all share. Where we are right now is, I do believe, given the quality of ShopRite, that one could buy ShopRite shares at the current price. You're not getting a bargain. It's not necessarily cheap, but it's a high quality company. And if we get some better economic growth in this country that will benefit the retailers, ShopRite is going to benefit from that, given their strong position. So yes, I own some ShopRite shares in the funds under my management, and I do like them, even at the current prices.
All right. On your side, Drikus, ShopRite, I mean, would you be seeing this downward movement as an opportunity to buy it, even though it is not cheap?
Yeah, I haven't got a particularly strong view on ShopRite. Won't stand in anybody's way buying it. Looks fairly valued relative to the market, cheap relative to its own history. Yeah, and that's about that.
Okay. Well, let's get into Prosus and Naspers. And actually, this was sent yesterday. So Naspers down, Prosus up. Should these two stocks not move together? That's an interesting question, JP.
They should move together, and generally they do move together. It doesn't necessarily mean that every day the percentage move is going to be exactly the same, because Naspers does trade at a discount to Prosus. So at the moment it's a single-digit discount, but it was in the past even a double-digit discount. So you are getting a better deal if you want access to the underlying assets, which is mostly Tencent, and then the basket of other operations. When you buy Naspers, it's a bigger discount. And generally the two move together, but not in lockstep. And it comes down to people speculating on whether there'll be any further corporate action when it comes to dismantling this structure, because it is a bit strange that you have two holding companies. You have a holding company of a holding company. And that's why there's a double discount. But the way that the automatic share buyback is happening, it is decreasing this discount. It is very good for Naspers and Prosus shareholders. And as long as it continues, it should continue to be good for specifically the Naspers shareholders that have benefited more from a narrowing of the discount. So yes, they do move together, but not exactly in lockstep.
Also, JP, before I move on to Drikus, this stock split that's coming with Naspers, could that also maybe increase these divergences between Prosus and Naspers, or maybe not?
On a rand per share basis, perhaps, but it should not on a percentage basis. So if you look at the percentage move in the share price of Prosus and Naspers, before and after the Naspers share split, the percentage moves per day should be the same. It's just that the Naspers cake is being cut into a few more pieces, but the percentage moves stay very similar between the two companies.
Drikus, is it always a good time to buy Naspers and Prosus?
No, I wouldn't say that. Are very dangerous words. Always a good time to buy something. No, I had a colleague in my, 15 years back, and whenever gold fell, he said, "When is a good day to sell gold?" And he said, "Every day." Well, look at the gold price now.
Yeah.
So never, marry a certain investment outlook.
Okay.
But no, I think Naspers is, China is printing money at the moment. I don't think many people recognize they're running a 10% deficit to GDP at the moment. That's going to flow through consumers' pockets somewhere. It's going to go through, Tencent's businesses, and if the discount doesn't widen, which it shouldn't, then Naspers and Prosus would benefit, obviously. So yeah, the big problem there is geopolitical risk. Obviously, I'm a proud holder of some Sberbank, the Russian bank. We still hold some of those in the portfolios. We actually did very well in 2022, but we lost about 3 or 4% of our portfolio in Russian assets. And that is unlikely, but as time goes on, that likelihood is increasing that something might happen between the two great powers on planet Earth. So just keep that in mind. That is a tail risk. And I'd rather not hold 20% of Naspers in your portfolio.
All right, let's get into more questions. And this one is on Spur. What do you think of Spur's prospects in the short to medium term? Drikus, their momentum has actually seemed quite good, hasn't it?
It's great business. Not particularly excited about consumer-facing stocks in SA unless there's something happening, and corporate action-wise or something, or unless it's at bargain basement prices. But I'll quickly enter something like Spur if growth surprises to the upside, but I'm just not there yet.
Yeah, and actually just looking at that chart, it has been on a downward trend, I guess, for the past few months after a very, very big surge. JP, Spur at this point, Spur, I guess, would also be considered maybe more higher quality than Famous Brands?
Well, they've definitely out-executed Famous Brands the last few years, especially since the new management team came in at the helm of Spur. So very well done to them. I like both businesses. And even though Spur has out-executed Famous Brands, I wouldn't mind, and I do have both in my portfolio.
Okay.
I like both.
Okay.
So Spur is the one that's operationally doing better. and the share price movement has reflected that and still reflects that. While Famous Brands has been a bit disappointing when it comes to the execution, and that's why the share has sort of gone sideways for quite a while. So at this point in time, I'm hopeful that Famous Brands can improve on the execution and catch up. But you're buying it at, I think the yield is above 6, if not almost 7% on a forward basis on Famous Brands now. Very cash generative.
Yeah.
So both business models, very good, being a franchisor, and then here and there operating some restaurants or takeaway outlets as well, but mostly a franchisor, low capital intensity, high cash generation, and I like both businesses.
Drikus, I mean, as you're talking about, waiting for something to happen in the economy, we have Bidvest that is seen as a bellwether for the South African economy, but actually it's known to outperform the economy. But right now, it just seems that there's a dampener effect that's been put on it. Even today, it's down 3%. What is the market thinking at this point?
Well, Bidvest was always, Brian Joffrey was a very good capital allocator. And I don't think, the small acquisitions that you can do these days are moving the needle for Bidvest. So they need to look at other ways of moving the needle, perhaps a few larger acquisitions, you never know. Perhaps they should restructure the portfolio. If that should happen, I would look at them again. But it's like you said, it's a bellwether of the economy. So unless I really get excited about the economy, I'm going to struggle to get excited about Bidvest.
JP, I don't know. Do you think that because it's also seen as one of the higher quality businesses, do you think that maybe investors are too negative, or if I guess their concerns are valid at this point?
It's an interesting one. So they recently refinanced a bond at a much higher interest rate. So all of a sudden, they're going to spend a lot more on interest expense. And that was offshore, because that's where most of the capital has gone the last few years. They've made some offshore acquisitions. So the vast majority of the capital has been allocated offshore. And the jury is still out whether that has been a good allocation of capital. The one big business they bought was loss-making when they bought it. So we need to wait and see if they can turn that around and turn that into a profitable business in the UK. So I'm also a little bit on the fence here on Bidvest. So your SA engine is not growing. It's not necessarily chugging along very nicely. And then there's a question mark about where your capital is going, which is into offshore services markets. So I'm on the sidelines until we get some better idea from Bidvest that their strategies, both in South Africa and offshore, are working and are generating good returns on capital.
We'll talk about a strategy that is working. Definitely Remgro's strategy. It did release its results today. I'm actually surprised that the share price didn't move much. It just moved, I think it was up more than 1%. I expected better considering what they produced. Drikus, your take on Remgro?
Yeah, you must remember that they also unbundled the eMedia holdings today. It was a dividend in specie.
Okay.
You will see that on your accounts maybe by the end of the month, before the end of the month. And so, it's actually up a bit more, a few percentage points. I'm not sure, I haven't done the calculations. And Remgro is following a corporate restructuring slowly but surely. They're moving very slowly, but they are rationalizing the portfolio, getting rid of the stuff that they do not want to hold. Long-term, actually delisting some of the stuff that they really want to hold. And I think what you're going to see perhaps with the exception of the big finance companies that they hold, they're going to have a very large unlisted book. And I won't even be surprised if they delist some of the big financial companies that they hold, So I think going forward, you'll see them continuing as an investment holding company, but the bulk of the NAV will make up delisted instruments. And then, asset managers like me and Jean Pierre can't say, well, we can hold those ourselves. We don't need Remgro for them, and thus you should trade at a huge discount. So that should theoretically narrow the discount, because then the only way into those very good businesses like, let's say, Mediclinic, is through Remgro. And so maybe it'll work. I think there is more value to add. It's still trading at a very steep discount, 40% plus. I haven't updated my model yet, but I think according to the latest NAV, the reported NAV that's already old by a few months now, it's 45%, but I think the actual numbers is a bit less than that if you model the listed companies. But some good businesses in there, and I do think they will continue to try and unlock some value.
Yeah. Well, JP, are you seeing the runway for shareholder value growth there becoming longer and steeper?
Longer and steeper. Yes, I hope so. It's interesting that even though they've been trying to pivot more towards unlisted investments, the part of the portfolio that is exposed to listed investments has actually grown as a percentage of the portfolio the last 3 years. But that's only because the likes of Outsurance and Discovery have done so well for them. So, yeah, they say they're on the front foot and they want to do more corporate action. So it could be very interesting to see what they do next. They're in a net cash position. They've got a very strong balance sheet. I quite like that, I can buy Outsurance directly myself. I don't need to get it in terms of a bundle of other stuff like a few hospitals and sunflower oil and who knows what else. So, I'm questioning whether investment holding companies that have got such significant stakes in listed companies have got a right to exist. And that's why it's trading at such a big discount. The market is telling them, listen, guys, you need to do something because you don't really need to exist if you've got, say, 2/3 of your portfolio in listed investments. So, let's see what they do next. The heat is still on, the pressure is still on. They can't stop now. They need to continue with working on the portfolio and do something so people get excited about Remgro again.
All right. Well, before we get to your stock picks, Drikus, I'm going to be asking you about PayPal, and then JP, there's a question for you on exposure to Latin America. PayPal. Your view on PayPal, Drikus?
I'm having on a strong view. I think it's derated a lot. I haven't looked at it recently. So maybe it's an opportunity. I don't know. I'll pass on commenting on this one.
Okay. Well, JP, just so that we don't run out of time, views on exposure to Latin America. And can you please make a comparison between Capitec and New Holdings?
Two very similar businesses. You can call them fintech businesses or new tech banks. New has got no branches. It's a credit card based system, very dominant in Brazil. It's moved to other countries like Colombia and Mexico, and very good management team. They've built ecosystems, started with banking, gone into payments and investments and all kinds of other associated value added services, similar to Capitec. So I like both businesses, both very good businesses. And I'll add another one in the mix, Mercado Libre, which is also a South American business. Together with Nubank, they are the two biggest fintech businesses. It's got a little bit more of an e-commerce flavor rather than just banking, but there's also a transactional type offering that they offer. So yes, these high growth e-commerce or fintech businesses are very attractive in my opinion. And I like Nubank, and it does remind me a lot about Capitec, yes.
All right. Well, talking about finding opportunity, let's get into your stock picks. Drikus, what are you choosing today?
Yeah, well, I'm feeling brave today, so I'm going with Avenge. It's still falling, so you're likely to catch a falling knife here. But I don't think it will fall to the floor. There's a lot of cash on the balance sheet still. A lot of the losses you'll see that's recently reported is from legacy contracts. If you cut off those legacy contracts, the rest of the order book is profitable, and the management has alluded to doing something about the structure. Well, they have. There's a lot of unbundling that's already happened through Avenge, and I don't see this company continuing to be listed. Over the longer term. I think they will, reach for some kind of transaction, maybe sell the Australian business and keep the local one, or wind down the local one. I don't know. Woolmans, they've got some contracts locally. I don't put too much value on that, but the offshore business, including the cash, I think is at least 3 times, conservative estimation, 3 times the value of the current market cap of Avenge.
Very interesting. JP, where are you finding value today?
I'm finding it in the elevator and escalator market, Zanati. So there are 4 big players in this market. I'm picking Otis tonight. It is listed in the US, so the share price is in dollars, quoted in dollars, but it makes its money around the world and significantly in Europe and Asia, like China. Think about all those high rises they built in China. They all have elevators, which means because the dollar is weakening, that benefits them on their reported dollar profits. And when I compare Otis to Cone, which is the Finnish business, Schindler, the Switzerland elevator business, and ThyssenKrupp, which is the big German one, these 4 dominate the industry. And there's talk that maybe Cone and ThyssenKrupp will merge, taking it to 3, then Mitsubishi being a smaller 4th player. And that means the industry structure is very profitable when you have less players competing. And all these elevators must get serviced. So they make a lot more money from servicing elevators versus installing new ones. That has slowed down because less high rises are going up in China. But with installed base currently, a weakening dollar, a concentrated industry, I think Otis shares are looking quite attractive at the moment.
All right. Well, thank you so much for educating us today, gents. We really appreciate your time. That is all for tonight's Stock Watch. Thanks to our guests, Jean Pierre Verster from Protea Capital Management and Drikus Combrinck from Capicraft. Up next, The Close. Stay watching.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.